Welcome back. Last week, we talked about the risk assessment portion of the audit process, both from the client's perspective and from the auditor's perspective. Now we're moving to the internal control evaluation portion of Chapter 5, looking at it strictly from the auditor's perspective. So recall, internal controls are processes that are implemented to provide reasonable assurance that the information system is capable of producing financial reports according to GAAP. This was the lying objective. If an internal control system is functional, it'll keep management from lying about what's on the financial reports. It'll provide reasonable assurance that operational efficiency is promoted and improved. In other words, it'll prevent management and employees from stealing from the company, making sure that assets are accounted for, assets are maintained. And finally, reasonable assurance that the organization complies with laws and regulations. This is the controls designed to prevent cheating, making sure that the people who are doing the job for your company are doing it in accordance with the laws and regulations that the company must abide by. So last week we discussed the management's responsibility for establishing internal control. This week we're focusing on the auditor's responsibility. The auditors are responsible for evaluating the sufficiency of the internal control system as the basis for audit testing. And we're going to look at that process, which is three-pronged. Auditors, in evaluating the internal control of a client, must first understand and document it. Then they assess the control risk. And these first two steps are often done in tandem with one another, provided that the client is not publicly traded. If the client is publicly traded, then the auditor is required to do an integrated audit of both the financial statements and the controls over financial reporting. You would have covered this in your outside readings this week. Finally, the auditors would identify the controls that need to be tested and test them. The auditors use the 5 components of the internal control framework, that CRIME, to form the bases of their assessment of control and risk at the financial statement assertion level. In the first phase of the auditor's internal control evaluation, the auditor gains an understanding of the client's internal control system and documents that understanding. The objective of this phase of the audit process is to determine whether the client has implemented controls over all relevant assertions related to the significant account and financial statement disclosures. As a memory refresher, the relevant assertions are completeness, valuation and allocation, existence and occurrence, rights and obligations, and understandability. A helpful mnemonic to remember these is cover you. At the end of this process, the audit team has gained a perfunctory understanding of the control environment, the flow of transactions through the accounting system, and the design of certain control activities. This understanding of controls extends to both entity-level controls and transaction-level controls. Entity-level controls are controls that contribute to the functionality of the internal control system and the reliability of the financial statements taken as a whole. At the transaction level, these are controls that pertain to specific classes of transactions, account balances, and disclosures. By gaining an understanding of the entity-level controls and testing their validity, an auditor can potentially save themselves from extensive substantive testing if they can prove that those controls are reliable. Walkthroughs are a useful tool to gain an understanding of controls. When performing a walkthrough, an auditor uses inquiry, observation, and document review as they walk a single transaction from its origin to its financial reporting. Walkthroughs are an effective way to gain an understanding of the transactional flow, learn the points at which a material misstatement could occur, identify the controls that management has implemented, and learn what control activities occur and what documents are used within the internal control activities. Within this phase of the control process, the auditor is gaining an understanding and appreciation for the effectiveness of control design. When evaluating the design, the auditor asks whether the controls that should be in place are in place, and if they are designed in a way that would prevent and detect errors and fraud. We'll talk about the effectiveness of control operation a little bit later. So a number of tools are used to document the understanding of internal control, and it is required for auditors to document their understanding of internal control. This is a fundamental portion of the working papers. First is an internal control questionnaire. This is a simple yes/no checkbox. Its benefit is that it's efficient. It allows you to quickly see the no's and then use that to shape your control assessment. The downside is that clients get to figure out that the no's are bad things. So in an attempt to provide socially desirable answers, the audit client might be tempted to just start giving yeses. A narrative description describes what happens as the control function. And finally, as you see to the right, is a flow chart, which shows the decision points, the control points, the potential weaknesses. It allows the control process to be seen as the bigger picture. It allows the auditor to identify control deficiencies and weaknesses, and it's something that becomes a living, breathing document. Although the auditors are required to document and gain an understanding of internal control each year, they can use their flowcharts and the accompanying narratives as a starting point, making updates as needed for the controls. In the second phase of the auditor's control assessment, the auditor identifies the controls that will best mitigate the risk of material misstatement for each relevant assertion. And just as a refresher, here's what they are. The auditor will identify whether those controls need to be tested and whether the nature, extent, and timing of audit procedures will need to be adjusted based upon the results of said testing. A well-designed internal control system should clearly link the key internal control activities to the relevant financial statement assertions. Although the auditor is not yet testing the effectiveness of control operation, the auditor is evaluating the need for such testing based on the cost benefit, based on the risk of material misstatement, and based on whether they can trust the controls. So this slide is a refresher again. Risk of material misstatement has two components: inherent risk and control risk. The second phase is what auditors are evaluating as they determine how much faith they, the auditor, want to put in the client's control system. If they can put a lot of faith in the client's control system, that is, if the controls are effective, then they won't need to do as much substantive testing. However, if they don't want to put a lot of faith in the client's control system because the controls are lacking, because they don't have faith in management, then they would need to do more substantive testing and less reliance on the control system. So let's go back to these practice scenarios now that we've gone into a little more detail about control risk. In this first scenario, you learn that your client's former controller left the company under auspicious circumstances and that the client restated and reissued their financial reports. Not knowing much about the control system, you can tell that the control environment itself is lacking. The client's former controller was clearly up to no good, and something was up with the control activities because the client had to restate and reissue their financial reports. Therefore, even with as little as we know about the client's control system, we can assume that the risk of material misstatement is high. Therefore, we'd switch up our audit testing procedures. With regard to the audit testing nature, we do more substantive testing rather than analytical testing, where we're looking at the balance or the transaction as a whole. We look at large sample sizes to cover more activities rather than small. And we'd push our audit procedures to the year end, which is when the reporting takes place, so that we have faith that everything is good before it goes out to the investors. Now let's look at the second scenario. Again, I'm not giving you a lot of details to work with, but what I am giving you makes it look like you can put a lot of faith in the client's control system. Management believes in and is committed to promoting the control environment, and your initial review of controls seems to indicate that the control system is strong. Therefore, you can assess the risk of material misstatement as low because you can put a lot of faith in the client's control system. This means you can do less work. You can look at analytical procedures, which look at account balances in their total rather than looking at individual transactions. You can test smaller sample sizes when you do perform substantive testing, and you can push some of that testing back to the interim period because you know that the control system that produces those financial reports is reliable. So what's coming out of them throughout the year is probably good. In the final phase of the control assessment, the auditor identifies and performs tests of controls. Again, the auditor at this point has made sure that controls align with the relevant assertions, and there they are again as a refresher, and that the auditor is performing tests that promote the verification of these assertions. Now, auditors can perform tests of control based on sampling, which is testing a representative subset of the population. This is generally performed on manual controls, or by looking at all occurrences of the control activity. This is generally performed for automated controls. And it's important to note that as companies adopt accounting information systems and use computers for more and more of the basic accounting functions, the testing of controls will move more to the population testing and away from the sampling testing. Now, there are 4 primary types of control tests that an auditor can perform to verify their effectiveness. An auditor can re-perform the control activity, gaining their own knowledge of the process. An auditor can review external evidence of the control by reviewing customer-provided invoices, by providing customer-provided checks or canceled checks, by looking at bank statements. Anything that came from outside the client is going to be more reliable than anything provided by that third bullet inside the client, because the client could manipulate this information. And finally, tests of control can be performed by oral evidence or inquiry. I've listed them in reverse order, the way the book has them, because this, you can see the first letter of each of those phrases makes another easy to remember mnemonic. A, E, I, O, and U means you got to remember this. Let's test your understanding of this control testing process by looking through some former CPA exam questions. This first one asks, after performing risk assessment procedures, the auditor decided not to perform tests of controls. Why? The auditor most likely decided, and I'll give you a couple seconds to read through that, your choices, and think about it. The correct answer is A. The auditor likely decided that it would be inefficient to perform tests of controls that would result in a reduction of planned substantive tests. For a public company that's required to issue financial statements, we know that the auditor must evaluate both the financial statements as well as the internal controls over financial reporting. So the auditor can't just curtail the audit and move on. They have to perform tests of controls as well as substantive testing. But for non-issuers, they have the option to perform tests of controls if it would give them a better understanding of the organization and would mitigate some of the needed substantive testing, or they can strictly perform substantive testing. If performing tests of controls wouldn't do anything to reduce the required substantive testing, then it's not cost-benefit effective. Let's look at the other choices. B, a reduction in the assessed level of control risk is justified for certain financial level assertions. Auditors are required to validate all of the Cover U financial statement assertions, regardless of the assessed level of control risk. C, the assessed level of inherent risk exceeded the assessed level of control risk. Remember that the risk of material misstatement is based on the inherent risk and the control risk alike. If the assessed level of inherent risk is high, then that means that the overall risk of material misstatement is also high. So C is incorrect. And finally, the available evidence obtained through tests of control would not support an increased level of control risk. You use the control risk to determine what tests of control to perform, not the other way around. So D is incorrect. Let's try another one. Which of the following statements is correct regarding an auditor's assessment of control risk? And I'll give you a couple seconds to think through it. All right, the correct answer is B. Assessing control risk may be performed concurrently with obtaining an understanding of the entity's internal control. Let's take a look at some of the other choices and decide why they're wrong. Item D, evidence about the operation of controls in prior year audits may not be considered during the current year's assessment of risk. That's kind of true. You do have to gain an understanding of the controls each year. However, you can still use the prior year's assessment of risk as the basis for your current year's assessment of risk. Item C, the basis for an auditor's conclusion about the assessed level of control risk need not be documented. It needs to be documented. It's a required component of the working papers. And finally, A, the lower the assessed level of control risk, the less assurance the evidence must provide that the controls are operating effectively. Again, that's kind of true. If you're assessing the control risk as low, that means that you have a high level of faith in the controls. So you don't need to do as much substantive testing. But the evidence that you do collect must still support that the controls are operating effectively. You still need compelling assurance, even if the control risk is low. Let's try another one. Okay. When the auditor's risk assessment is based on the effective operation of controls, the audit will most likely involve, and I'll give you a couple seconds to think about your answer. The correct answer is the first level A. identifying specific internal controls relevant to specific assertions. So if you're performing an audit, you want to make sure that the internal controls are aligned with the relevant assertions and that those relevant assertions are designed to prevent material misstatements. If a control doesn't relate to a relevant assertion or doesn't promote financial reporting that's free from material misstatement, if it's not related to the financial statements, you don't have to test it. It's not worth your time. So let's look at the other letter A's and why they're incorrect. The second one, changing the timing of tests by omitting interim date testing and performing tests at year end. That's a strategy you would take if the auditor's assessment of controls is ineffective. Remember, because you'd push your testing to year end so that it's closer to when you're reporting the financials, because you want to make sure the financial statements are free from material misstatement, generally. The third letter A, performing more extensive substantive tests with larger sample sizes than originally planned. Again, that's something the auditor would do when they can't trust the control system. Less trust in the control system means more work, which means more substantive testing and more sample sizes. And finally, the fourth letter A, reducing inherent risk for most of the assertions relevant to significant account balances. Again, risk is inherent when it's risky because it is. You still have to test the assertions, even if you assess that the controls are effective. Last one, I promise. This one gets into the evidence, which we talked about in the very last slides. Which of the following would provide an auditor with the most reliable evidence regarding the existence of accounts receivable? And there's one of those relevant assertion words in there, existence. So I'll give you a couple seconds to think about that. The correct answer is A, an accounts receivable confirmation received by the auditor from the client's customer. So, like I said, this has to do with two things. It has to do with the reliability of evidence as well as the relevant assertions. What are you proving when you're proving existence? You're proving that a transaction did actually happen. So, item B, if the auditor prepared the aging schedule, then that would be reliable evidence because the auditor was able to take the documents and the system information and reproduce what the client said. But we're looking for existence, which has to do with does the transaction exist? So B is out. Items C and D, a copy of the customer sales order held by the client and a copy of the invoice sent to the customer, those are both internally generated items. And remember the hierarchy of reliability, the most reliable is the auditor reperformance because the auditor knows. It's followed by external evidence, then internal evidence, and finally the O, which has to do with inquiry. So the only one of those choices that has to do, that's provided externally is the accounts receivable confirmation. So A is the correct answer. Your discussion board post this week gets you thinking about the cost-benefit analysis of audit procedures, which is a good segue and sign off from this slide. So, while audit reperformance of evidence is the most reliable, it's also the most labor intensive for the auditor, which means that it's the most expensive for the client. So a proper audit should balance these different techniques. But there's a cost-benefit analysis to the control testing. Think about that and go forth and conquer.